Coming up on Business Incorporated, investment bank J.P. Morgan removes Nigeria from its list of emerging market sovereign recommendations. Plus, Ethiopia joins Kenya, rolling out 5G network in Eastern Africa. Regional central bank slams Central African Republic for adopting Bitcoin. Hello and welcome to the program. I'm Ladi Williams. First off, let's take a look at how your money's performing at intraday. Trading in Africa kicked off the midweek session positive. At intraday, Nigeria's main index, which was the biggest gainer, jumped 2.13%. While crossing the 52,000 points level, while South Africa's benchmark index climbed almost 2% on the day. Elsewhere, Egypt's index also traded higher by 0.41%, while the Nairobi Stock Exchange closed Tuesday negative, down 0.26%. Over to the Middle East, there was mostly negative sentiment at intraday, with Qatar the sole gainer. The Abu Dhabi index fell 0.23%, and Dubai index dropped 1.81%. Still within the region, Saudi Arabia's index dipped by 0.83% at intraday, while the Qatari index was a lone gainer, rose by 0.16%. And now let's head on to Europe, where the gas wars keep flaring. We have right there Chris Koba in Berlin join us. Great to have you, Chris. The ongoing fighting in Ukraine has said it will stop Russian gas shipment through a key hub in the east of the country. Quite interesting. Tell us more about this.
Ukraine's natural gas pipeline operator indeed has stopped Russian shipments through the Novopskov hub and is claiming it is necessary because of interference from, quote, occupying forces, including the apparent siphoning of gas. We have to understand that this gas hub is located in the east of Ukraine, in the Luhansk region, which declared itself separate from Ukraine years ago and is now largely controlled by Russian military. The Ukrainian pipeline operator said the hub handles about a third of Russian gas passing through Ukraine to Western Europe. Russia's state-owned gas company Gazprom puts the figure at about a quarter. So this is quite a significant announcement because it is the first time natural gas supply has been affected by the war that began in February, and that's something that Europe, still heavily relying on Russian gas deliveries, has been dreading. Albeit the concern has been more over Russia turning off the taps, which in case of the two EU and NATO countries, Poland and Bulgaria, it indeed already has.
Yeah, quite interesting. But what are the consequences of this move?
Now, a cut of deliveries at this hub could have quite an impact because, as mentioned before, about a third of all the daily gas deliveries from Russia to Western Europe run through it. And indeed, it appears to be showing. Russian gas producer Gazprom said it continues shipping gas to Europe via Ukraine, but with volumes down from Tuesday. Gazprom did not say if that level was in line with requests from European clients. And data from Slovakia's national operator showed that nominations for Russian gas deliveries via Ukraine have fallen. Now, Ukraine's move may force Russia to shift flows of its gas to territory controlled by Ukraine to reach its clients in Europe. Gazprom initially said it couldn't reroute the gas, though preliminary flow data suggested higher rates moving through a second station in Ukrainian-controlled territory. The German Economy Ministry said the country's gas supply is currently still secure, and the German Gas Industry Association claimed it could only assess a possible impact of the Ukrainian gas transit points shutdown after seeing how flows develop.
All right, Chris, but European markets rebounded, somewhat from what has so far been a dismal month of May. What does the picture look like today?
Well, European shares rose on Wednesday, extending a rebound from two-month lows hit earlier this week. Amid a slew of quarterly earnings reports, investors are eyeing official U.S. inflation data later today, and analysts are predicting the recent record inflation of 8.5% having eased off somewhat in the U.S. 8.1% is their prediction for last month. But the big question remains, have rising prices in the U.S. peaked, or are there more months of rising inflation to come, which would most likely trigger even quicker tightening of monetary policy by the U.S. Federal Reserve? Now, in light of the news to come, the DAX is trading surprisingly strong to the upside, gaining around 0.6% in the early parts of Wednesday's trading. Shares in Asia were mixed, with Chinese benchmarks pressing higher after a rally in technology companies helped reverse most of an early slide on Wall Street.
All right, Chris, right there in Berlin. Thank you so much for the update, Chris. All right, now let's move on to the UK. We have Juliana right there. Well, Juliana, the squeeze keeps on squeezing. The National Institute for Economic and Social Research is saying more than 250,000 households will slide into destitution next year. You know, taking the total number in extreme poverty to around 1.2 million, unless the government acts. I guess the bleak outlooks keep mounting here.
Yeah, that's right, Laddie. And that 1.2 million is a really conservative estimate because the headlines that I've been reading suggest 1.5 million households could be forced into extreme poverty by the end of the year. And we're talking about a G7 nation here, the United Kingdom, allowing so many of its citizens to struggle to put food on the table. And now this is all about the reopening of Parliament and yesterday's Queen's speech, which we know was delivered by the Prince of Wales. And now the 38 bills that were addressed yesterday, of course, tackle legislation. And we know that in a crisis, it's not about legislation, it's about quick fix policies that can help turn the lives of people around. And that is what is missing. And that is why the Chancellor is under immense criticism at the moment. I was watching the debate yesterday, and there were times where he did look like a wounded puppy because there was a barrage of opposition bench MPs suggesting that he must do something or else his legacy will be in shatters. But the think tank have released this data today. They've conducted a survey speaking to a raft of people living up and down this country, and they're all saying the same things, that they are struggling to pay their bills. Lots of elderly individuals as well who get particularly cold are having to keep the heating off just because they cannot afford these fast rising bills. And not only did energy bills increase by 54% last month, in October, they are going to increase again. So what the National Research Institute have suggested is that the Chancellor offer 40% of the poorest families in the UK a £250 one-off payment. I know the Naira fluctuates quite often, so I'm not sure what that is unless somebody in my ear tells me the equivalent of that. But that one-off payment will cost about £40 billion, and it's something that at the moment it doesn't seem that the government is prepared to do. They have been doing, as to be expected, the media rounds this morning, and they're talking about pre-existing policy that they've already put in place, pummeling lots of money to local councils so that if anybody is in an emergency situation, they can be offered grants. But it's not good enough. We know across the world individuals are struggling because of the COVID-19 pandemic, made worse by supply chain bottlenecks and inflation. And then on top of that, there's the war in Ukraine, which has completely stopped the breadbasket of Europe from flowing. But according to so many people who are watching what's happening in the United Kingdom, government policy is making things a lot worse. I anticipate a U-turn anytime from now.
So much for the government and central bankers to do at this point. But another research, this time for the labor market, shows that 2 in 5 workers are anxious about returning to the office as life gets back to normal following the worst of the coronavirus pandemic. That's quite interesting.
It is quite interesting. Those who were conducting the surveys definitely didn't speak to us, Laddie, because we're anything but anxious to get to work. We've got to be in the office. But this survey, exactly, it was conducted by Slack, which is a messaging app. They spoke to about 1,000 individuals who have been working in a hybrid fashion. And yes, many of them are worried about going back to the office. They don't believe that their bosses care about their mental health, care about their work-life balance. And also, again, when you're talking about the UK and you're talking about work, you've got to talk about the cost of living. I remember during the pandemic, when all of the non-essential stores were closed, you weren't spending money on coffee. You were satisfied with using the office kitchen and you were bringing in food from home. Now that everything is open, people are worried about spending money again. It also costs a lot of money to travel on London transport, especially if you're somebody that's living outside of the city and you're having to commute in. We know that for decades, lots of people have been complaining about just how expensive it is to travel into London. Those are the concerns. And it's really interesting because this has now become a topic of conversation in the UK about the battle of those who want to work from home and those who want to stay in the office. And we've had some pretty senior figures calling people who do want to work from home lazy, and they're not helping the economy. But considering that, you know, we are going through such a tough time at the moment, the toughest squeeze on household incomes in more than a generation. It is pretty serious and it's only going to get worse. So lots of people very comfortable staying at home, making their own cup of tea and not having to pay to travel or, you know, work colleagues stressing their mental health situation. Laddie.
Quite interesting. Well, it is cheaper working from home and no pressure from colleagues there. But how are the markets looking at intraday? We know it's not been pretty in those markets.
Yeah, it's hump day today, and the FTSE are actually started off in positive territory. It remains that way at intraday. The all share is up by 1.13%. FTSE 100 up by 1.11%. And the FTSE 250, the domestic market, up by a whopping 1.38%. In the currencies market, the British pound is currently trading up against the US dollar by 0.26%, up 2 against the euro by 0.06%, but down against the Japanese yen by 0.26% at intraday.
All right, Juliana, thank you so much for the update. See you tomorrow.
See you tomorrow.
All right, so shares in Asia Pacific were mixed there as investors watch for market reaction to the release of higher than expected Chinese inflation data for April. Mainland Chinese stocks led gains regionally, with the Shanghai Composite rising 0.75% to close at 3,058 points, while the Shenzhen Component climbed 1.80% to 11,000 points. Hong Kong's Hang Seng Index advanced 0.97% on the day to 19,824 points. All right, now let's take a look at what's happening in the U.S. We see stock futures rose 285 points, while the S&P 500 futures were up 1.1% higher, and the NASDAQ Composite jumped by 1.5%. Well, let's get yesterday's close, a summary from our correspondent, Mary Bird.
The U.S. stock market was volatile on Tuesday as the Dow Jones had its fourth straight day of losses, closing at 0.26% down. And the NASDAQ only made it 0.98% up, while the S&P 500 only made it up 0.25%. It is clear that many investors are concerned about the inflation reports that are due to be released on Wednesday. This is going to be a key indicator to what could occur with the U.S. economy. It is also clear that President Biden's announcements regarding the plans he has for economic recovery and how to manage through the inflation has definitely resonated with investors. But will it be enough to be able to ensure that many Americans trust that their pockets will definitely not continue to see an increase in prices and that they will be able to sustain their lifestyles?
As our correspondent, Mary Bird, with yesterday's close in the U.S. market. All right, we'll take a break now. When we come back, more stories on the African continent. Do stay with us. This is Business Incorporated. Welcome back to watching Business Incorporated. To more stories now. Ethio Telecom, the state-owned telecom service provider in Ethiopia, launched a 5G mobile phone service, making Ethiopia among the leading new African countries, including Kenya, Eastern Africa, to roll out the technology. According to Ethio Telecom, the network will be available on hotspot areas in the capital, Addis Ababa, including in the area around Ethio Telecom's office at the premises of the Bola International Airport before being expanded to cover other parts of the country. 5G commercial networks have been launched in key countries such as Botswana, South Africa, Seychelles, Mauritius, and Zimbabwe. This technology remains largely underdeveloped in larger parts of Africa. And after the Central African Republic adopted Bitcoin, original monetary authority says it is in disregard of a decade-old agreement on a common currency with 5 of its neighbors. According to the Central African Monetary Union, the C.A.R's announcement of the cryptocurrency as legal tender last month was made without consulting the Bank of Central African States and goes against a fundamental rule that all 6 states of the Central African Monetary Union should use the CFA franc. The African nation became the second to adopt Bitcoin as legal tender after El Salvador, despite concerns around using cryptocurrencies and its low internet connectivity. The government said Bitcoin will spur economic growth and help to stabilize the war-wrecked country. And now to our next conversation. Well, JP Morgan, an American multinational investment bank, has removed Nigeria from its list of emerging market sovereign recommendations and investors should be overweight in. Well, let's discuss the implications of this with Mr. Bismarck Ronnie, CEO of Financial Derivatives Company. Great to have you on the program, sir.
Good afternoon, Ladi.
Good afternoon. Well, quite an interesting turn of events there. And I'm wondering, what is the implication of this delisting? Is it just about them not letting their clients invest in Nigeria's bond?
No. Let's step back. Why did they delist us? By being in this list, it means that your clients can buy your bonds and put it in their portfolio. You know, there are index investors who say, because Nigeria is in the JP Morgan index, they can buy. Now, first of all, Nigeria was delisted from the index in 2015. Now they've been taken off the list altogether. And the reason given is that Nigeria has failed to take advantage of higher oil prices and higher oil production, and that there's a liquidity as well as a transparency risk in Nigeria's foreign exchange market. And strangely enough, the countries that were added in place of Nigeria were Uzbekistan and Serbia. These countries are actually what I can call their profile is, in fact, if you look at one is B minus with a negative outlook, that is Uzbekistan, right? And while Nigeria has B plus and stable outlook, all that they're complaining about is a lack of transparency and lack of liquidity in Nigeria's foreign exchange market. And that has been a problem in Nigeria and it's been driving all the things that are happening. So in spite of the higher oil price, in spite of the production levels, we are seeing that our reserves are not growing, and we are seeing that the Naira is coming under pressure. So this is just about bringing stability and putting the Nigerian policymakers under pressure to try and reform the foreign exchange market in Nigeria to make it more transparent and more market-driven.
But how do we see this, impacting the Nigerian economy?
Well, the truth is that Nigeria has bonds, Euro bonds issued. Nigerian banks have Euro bonds that need to be either retired or refinanced. The moment you are taken off the list, the number of investors who can subscribe to your bonds will be reduced, which means that you would have to pay a higher price for your credit. And not only for your bonds, your Euro bonds, Nigerian bonds itself, state government funding, which is guaranteed by the Central Bank of Nigeria, and trade credit. So if Nigerian banks are even financing their, what they call their letters of credit, you need to do that. So basically, at the end of the day, you'll find that the cost of financing international transactions in Nigeria becomes higher at a time when there's electoral uncertainty as to what what the outcome of the elections will be in the next 8 to 9 months.
Well, but what do you think other investment banks, would be doing? Do you think they'll follow this trend?
Well, it's important because the risk here is that they're saying that because investors who have put their money in are unable to get their money out at an agreed rate, and when demanded, so that risk is a risk of default. The fact that you may default, even in spite of the fact that you have the resources, there's what we call the willingness to pay and the ability to pay. Nigeria might have the ability to pay, but from the structure of the market and the way the foreign exchange market is organized, there are doubts as Nigeria's willingness to pay, even though it has the ability to pay. So I think this can be addressed very quickly by restructuring the foreign exchange market, making it more open, more transparent, and allowing people who have naira to exchange their naira for dollars when they want it. And so dollars will come in and naira can go out, and therefore you will have an equilibrium in the foreign exchange market. That is what the problem is.
And what do you think we can learn from, the countries that were added, while we were taking out?
Well, strange enough, these countries are close to Russia. They are dependent on Russia, but they have markets that are quite transparent, and you can predict, even though their resources are nowhere near what Nigeria has. So it's a question of does Nigeria have a revenue problem or a management problem or a combination of both? This is what is happening here, and that is what we are seeing right now.
All right, Mr. Bismarck Rouhani, thank you so much for giving us your insight on this C.A.R Financial Derivatives Company. It was great having you on the program.
Thank you for having me.
All right, now let's take a look at the global oil market. We see oil prices rose today after plunging nearly 10% in the last two sessions, followed by supply concerns as the European Union works on gaining support for a Russian oil embargo and flows of Russian gas to Europe through a key transit point in Ukraine dried up. The EU has proposed an embargo on Russian oil, which analysts say would further tighten the market and shift trade flows. A vote which needs unanimous support has been delayed as Hungary has dug in its heels in opposition. Brent crude was up $2.93 to $105.39 a barrel, while U.S. West Texas Intermediate crude climbed $2.96 to $102.73 a barrel. And to the metals market, gold rose, supported by a pullback in the dollar and U.S. Treasury yields, while investors prepared for U.S. inflation data that could determine how aggressively the Federal Reserve will hike interest rates. Spot gold rose 0.7% to $1,850 per ounce, by rebounding from its lowest since February 11th, touched earlier in the session. U.S. gold futures gained 0.6% to $1,852. The dollar dipped 0.5%, but was not far from a two-decade high touched Monday, while the benchmark U.S. 10-year Treasury yields retreated from recent highs. Spot silver gained 2.5% to $21.76 per ounce, while platinum climbed 2.6% to $988.93 per ounce, while palladium eased 0.2% to $2,060.96. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.